Well, good morning and welcome to the Plato Webinar. My name's Mark Cormack from Pinnacle Investment, and Pinnacle are equity partners and work alongside Plato to distribute Plato's Australian and global income funds to the financial advisory marketplace. And today I'm delighted to be joined by one of Australia's leading experts in the area of equity income investing, Plato's Managing Director, Dr. Don Hamson. For today's webinar, we're going to provide an update on the global and Australian equity income market. We're going to discuss why it has been a dividend bonanza here in Australia, with Plato on track to deliver over 15% gross income for the year, how global equity income has been looking, and provide an update on the ALP franking credit proposed policy. Just as a bit of background, Plato has a unique approach to managing money because it's one of the few fund managers who fully assess the after-tax implications of their investments. And this has resulted in the Plato team developing high-yielding equity income solutions in both Australian and global equities. And these are structured specifically for low-tax investors such as retirees. And really, because CGT is no impediment for low-tax investors, Plato actively rotates through dividends to deliver high income. And while income is a major focus, Plato also aims to outperform the index on a total return basis. And over the past 12 months, the Plato Australian Shares Income Fund has outperformed the index by over 2%. So we're not sacrificing total return just to get income. It's important to note Plato have achieved this result in a very torrid market for traditional high-income investments such as the banks and Telstra, which have underperformed the index dramatically. Before we kick off today's webinar, just a couple of quick housekeeping items. Today's Plato presentation will last around 15 to 20 minutes, followed by Q&A. And secondly, all attendees have the opportunity to ask questions via clicking the Questions tab on your screen. So without further ado, I'll hand you over to Dr. Don Hamson, Plato's Managing Director, for today's presentation. Thanks, Don.
Thank you, Mark, and thank you, listeners. And again, apologies for our late start. I want to start with the dividend bonanza. I mean, it's just been a great time for collecting income. It is an absolute record year for our Plato Australian Shares Income Fund. As of the end of March, we've actually distributed about 15%, in fact slightly over 15% gross income after fees to our investors. That compares to our normally high level of 9%, so we're actually about 6% ahead. And our cash yield this year is running at 10% versus normally it's a bit over 6%. So a very strong income coming out from the fund in total return terms. Some of the drivers have been some very large buybacks by BHP and Rio, which we participated in last year, smaller one in Caltex just recently, and there's a Woolworths one to come. But there's also been substantial extra dividends. I mean, in the March quarter alone, we calculate that Australian dividends paid increased about 37% compared to the same time last year. Resources, again, were big drivers of that. BHP paid a big special. In fact, they paid $7 billion in a buyback back to shareholders, $7 billion in a special dividend, with about $6 billion in franking. So a massive release of dividends just from BHP alone. But other stocks like Fortescue and Rio and Alumina had massive rises in dividends. Some of the companies that have also been deliberately flushing out franking prior to the potential of an ALP change to franking, which we'll talk about later. So the likes of Woodside, Flight Centre, and even our own LIC PL8 have announced special dividends to help flush out excess franking prior to the 30th of June. And in fact, there's an imminent announcement about the size of the Plato Income Maximiser special dividend in the next few days. I would caution, though, that we would expect, this is a once-off, we would expect dividends to return back to normal levels post the end of this financial year to beat the ALP franking credit proposal, which is supposed to or expected to start 1 July, at least according to the ALP. You would actually need to pay dividends out and actually physically pay them to investors by June 30 this year. And indeed, in the next slide, we just document the massive income that we've generated. Our income is, say, 10.7 cash, 4.4 franking credits compared to the market, 4.3 and 1.7. I would say the market's yield is a little bit undercooked or underdone because the S&P don't count, which is interesting, they don't count special dividends as normal dividends. and so the index technically was probably a little higher than that because they didn't count those specials like BHPs. And as Mark has already suggested, it's been a strong period of return in what has been a pretty tough period for most active managers, not just income managers, but active managers in general, because many managers, I think, have missed out on the strong returns from resources, but we're a very active fund, and we move our fund to where the income is, and if resource companies are paying good income, then that's where we will go, and we've made quite a bit of outperformance in the resources sector. You can see pretty consistent performance overall, and the longer term slide there shows that we've more than made up for the weakness in the fourth quarter last year, that the Plato Income Fund continues to sort of reach new heights, and in fact we had strong outperformance in the fourth quarter last year. We didn't go down nearly as much as the market, but we've rebounded strongly in the first quarter, which is also good. We talked about buybacks, and an example of that is one that's in the market at the moment, hasn't yet completed, and that's Woolworths. We're well positioned to participate in that buyback. It's a pretty large buyback, a lot bigger than the Caltex one, $1.7 billion, about 4% of Woolworths market cap. And on our estimates, we have a paper on our website, we expect for every share you successfully tender in, I'll say successfully because there will be scale back, we expect tax-exempt investors to make around 16% return versus selling in the market, and so we find that very attractive. That is, to us, a low-hanging fruit for tax-exempt investors. So there's been a number of those this year. We expect that pace to slow down next year after 30th of June. It has been difficult for many active managers. On this slide, we just highlight the continued relatively poor performance of the banks and Telstra versus the market, but also, we have to invest in these stocks because they have high income, but we haven't been as overweight the Westpacs and the Telstras in particular as much in the last 12 months. But it is true that you can't avoid those stocks. The top 6 stocks, 4 banks and Telstra and BHP represent nearly, not quite actually, because the banks haven't been increasing their dividends and Telstra has cut its dividend by something like 48% in total and 68% from its normal dividend. There has been some weakness there, and the late incoming news that this morning NAB did announce its results for the first half, and whilst the results were pretty much in line with expectations, they did slice 16 cents off their dividend. They dropped their dividend from 99 cents this time last year to 83 cents today. That was a little bit more than we expected. We did actually expect them to cut their dividend a bit. But nevertheless, it's interesting that even if we annualise that number, NAB is still trading on a 9% grossed up income. So it's certainly not as bad as the large cuts we've seen from Telstra. And yesterday ANZ reported, and again, it was pretty much in line with expectations. And I think people were thinking the worst, and the banks all rallied yesterday. NAB has given back 1% today, and that's all. So even though it's cut more than expected, it hasn't been a massive underperformer. But they have been soft over the last couple of years. But we don't have to go into the banks, so we've done big rotations into other sectors, particularly in the resources sector, and that's important. And remember, one of the value adds of our process is that stocks that generally are in their run-up period or in the couple of months prior to their ex-date, they tend to outperform. And this is not just a phenomena in Australia around franking and those sorts of things. A few people have asked me questions. It's like, oh, well, if the franking credits go away, will we not see this run-up sort of situation? But it happens in every country. So Australia and New Zealand are the only developed markets that currently pay franking credits. So the run-up phenomena has got nothing to do with franking. In fact, on the slide we have there, the country with the largest dividend run-up is actually Germany, which doesn't pay franking credits. But it does pay a single large dividend. So that's one of the reasons. And I think Australia's focus and domination by the banks is also, and their poor performance of the banks and Telstra, I think that should question investors, put questions in investors' heads about whether they should have as much in Australia. And I think the franking credit question marks also suggest maybe people should look more globally. And whilst it's been a dividend bonanza in Australia, it's also been quite strong globally. So global dividends actually rose 19% Q1 2019 compared to Q1 2018. So that's a pretty healthy increase, 19%. And it's actually an acceleration on Q4 when we look back to the December quarter of last year versus December quarter 17, the dividend growth was 17%. So we've actually seen an acceleration of another 2%. And some of the strongest companies, Australia was the third strongest, but countries, Germany and the Netherlands had very strong dividend increases. And from a sector point of view, material stocks did lead the way, and many of those stocks are actually Australian, and we've already talked about the likes of Rios and BHPs and Aluminas. Interestingly, globally, the next best sectors were stocks in the IT and telco area, which is a little interesting because where Telstra is had another round of dividend cuts in the latest results in February. As I mentioned, it's now dividends 48% lower than it was 2 years ago. Telcos generally, globally, actually increased dividends by 33%. So Telstra's issue is not a global issue, it's a Telstra issue here with the NBN. Now, the topic of the moment is and for the last 12 months really, but it seems to be heightening up, is the ALP franking credit proposal. A quick update there. Clearly the election's only a couple of weeks away now. It looks like the ALP are certainly standing firm on their proposal. They're not backing down anymore. They did do a backflip initially 12 months ago and provided an exemption to part pensioners or Centrelink pensioners, but they haven't budged since then. Look, the polls and the bookies still suggest the ALP is going to win, even though the gap is narrowing, but in terms of the bookies' numbers, it looks they're still clear favourites. So unless there's a real change in the campaigning in the next couple of weeks, it does look like the ALP will probably win the election, but you're probably as much in the know as I am on that one, but they are certainly ahead on the polls and on the bookies. But it's important to note, and we've said this all along, that not only do they have to become government in the House of Representatives, but they will also need Senate approval. And they're unlikely to control Senate. They're unlikely to control Senate even with the support of the Greens. And the crossbenchers have reaffirmed recently, a number of articles have come out in the press, stating that they don't like this policy. Particularly the Centre Alliance have come out and said they'd like to grandfather franking for people. I don't know exactly how you would do that, but they're pretty vocal on that and campaigning on that basis. So I still think, and I've said this all along, it will be difficult for the ALP to get this proposal through the Senate in its current form, and it's quite likely they may have to water it down. The Standing Committee for Economics Inquiry was held over the last 3 or 4 months. It did write a report, and it was completed just before the election, around the time of the election being called. I mean, it wasn't any surprise that the findings of that inquiry went right down party lines. The Liberal chairman was pro or anti the franking proposal, and the ALP didn't change. So really it was a non-event. Just in going around the countryside, though, I would, and I think this slide here highlights the issue and to me the problem, and there is a slight error on this slide. The assets test would be 567, 250. It's incorrectly labelled in the second column, or third column, sorry. But this slide highlights to me the discriminatory nature of the proposal in its current form, in that most people, and this is what I think we should understand, is most people will continue to get their franking credits, and particularly most people in APRA-regulated funds that are net payers of tax, and that is the majority of the vast majority of APRA-regulated funds, the big funds like QSuper and Australian Super and the like, will still get a full refund of their franking in their pension mode, and so most investors in Australia, or most superannuants, will still get their franking credits. The areas, and unfortunately though, the areas, or the ones that won't get their franking credits, will be self-managed super funds in pension mode if they didn't have a pensioner on or before the 28th of March last year, pensioner member, and individuals. So they're the ones that that are not pensioners. If you're a pensioner, you get an exemption, but if you're a self-funded retiree, you own shares in your own name, you won't get a refund. If you're a self-managed super fund pension phase member, you won't get a refund. And talking to many people around the countryside, I think planners are aware of this, see this and actually see that for some clients and for hopefully many clients that are in, say, self-managed super fund, they may need to reconsider whether that's the appropriate way going forward if the proposal comes in and goes through Senate, but I think there's some question marks around that, hopefully there'll be some exemptions. But certainly I know a number of planners are saying, well, they will review their clients, and in many cases, or some cases, they will actually might move their clients from a self-managed super fund in pension phase and move back into an APRA-regulated fund, a platform, or whatever to get the franking back. So there are some opportunities for people to move. I just wanted to talk a little bit about some of the other tax issues for the ALP. We have a paper on this, but some of the other taxing issues, there are a huge number of taxes coming through. They propose to tax the income of discretionary trusts or the distributions from discretionary trusts at a minimum rate of 30%. They want to reduce the long-term capital gains discount rate from the current 50%. So currently you pay tax on half of the capital gain, of a long-term capital gain. They want to reduce that to 25% discount, so 3/4 of the gain will be taxed. Note that this policy, unlike the discretionary trust one and the franking credit one, is grandfathered and will only relate to assets purchased from 1 January next year. That was a recent announcement by the ALP. They're outlawing negative gearing except for new housing, so you can buy new houses and still negatively gear, but for other properties you won't be able to. But again, it's grandfathered and will only come into place for assets purchased after 1 January. Negative gearing also applies to shares, so if you have a negatively geared share portfolio, but indeed at current interest rates, not many portfolios would be negatively geared. And of course they want to increase the top individual tax rate from the current 45 cents to 47 cents, but of course there's a 2% Medicare levy. And they're reducing concessional super catch-ups, or actually abolishing them, and non-concessional, currently you can put $100,000 after tax into a fund, super fund, each year or 3 years in advance, and they're dropping that to $75,000. So we've got a couple of slides which just highlight the reduction in after-tax income. So these are all negatives because the tax rate's going up, but it means that your income is actually going down, or your after-tax value of $1 of taxable income. The biggest hits actually are really, and it's interesting, are for people who are currently tax exempt, so that's self-managed super funds in pension mode and individuals on low tax rates. The franking credit hit is 30%. That's a massive change. That means your income is going to decline by 30%. That is actually also the same hit potentially for those people from the trust change. So people who are getting trust distributions now, but they're tax exempt, will pay 30% tax. So that is a large change. But it affects all other individuals, and you can see at the top end, because the tax rate's just increased over there, it's the biggest hit is for the value of a long-term capital gain has quite a large increase in taxes, but you hit across all asset classes. So the hits keep on coming for investors. Negative gearing, this slide might be a little confusing, but they've got 4 bars for each tax rate, and the first 2 bars are the current situation. And it's probably best to understand this chart by just focusing on the right-hand bars, the very top marginal tax bracket. That's where the differences are easiest to see. You can currently say capital gains are taxed at only get a 50% discount, so they're taxed at half the rate. So you get about 80 cents back in the dollar from a capital gain, or just under 80 cents back in the dollar. Whereas interest is deductible at your marginal rate, so really you're getting close to a 50%. Cost of interest is virtually half of what you actually pay, and so there's a big gap between the two. What ALP are doing is basically levelling out those, because you can only carry forward your interest deductions to offset against the future capital gain. So basically a big change there for negative gearing in CGT. And just quick outlook. The other thing that's happened in the last 4 or 5 months is that interest rates not only remaining low, but possibly even lower, and there are strong odds that we'll see the next move in interest rates here in Australia will be a fall. It has been a record year for dividends. We've discussed that. But we do think that they'll return to normal next year, so don't expect the current levels to continue. But there is obviously significant political risk. But remember that just winning the election isn't enough. The ALP have to get these proposals through Senate, and that reflects all of the tax proposals, but I think the most controversial is the franking credit one. Now, probably time for questions if there are any.
Excellent, Don, and always fascinating to hear your views on the world of high income investing in the equity space. And as we mentioned, this is specifically a fund structured for low tax investors. A reminder, all attendees have the opportunity to ask questions via the internet, and this can be done by clicking that questions tab you can see on your screen. Look, while we do wait for some questions to come in, I thought I'd just reiterate a couple of points on Plato's approach. Plato is specifically designed for retirees, delivering high income in Australian and global equities. And in terms of Australia, Plato has delivered over 10% cash income plus franking, and then in global equities, 6% genuine dividend income. Don also mentioned PL8, which is Plato's listed investment company, which is one way to access Plato's investment capabilities via a listed equity, ticker code PL8. This pays monthly income, and as we mentioned, or Don mentioned, we have recently announced a special dividend, and there will be a further announcement on that in the coming days. With that, we will open it up to questions. Don, first question that came in during the presentation. In the past, you've mentioned Telstra being a dividend trap. Where do you see it at the moment, and is it still struggling?
Well, I mean, it's still struggling because it had a further cut in dividends. That highlights that it is struggling. Our view hasn't been that it's been a massive dividend trap, but our view is that it's going to cut its dividends, continue to cut its dividends and struggle. And it's basically signalling that to the market because even though the dividend is now down about half from where it was 2 years ago, some of that is actually in the form of a special dividend. Special dividends are usually don't continue forever. They're often just one-off. And Telstra has basically said, look, when the NBN payments that they're currently receiving cease, that the special will cease as well. So given that, we believe Telstra's dividend is likely to be about 68% lower than it was 2 years ago once the specials aren't paid, because ordinary is 68% less than it was 2 years ago.
Yeah, it doesn't look like there's any way up there for Telstra at the moment in terms of any growth. While we're talking dividend traps, there's another question, Don. Are non-bank financials, the likes of IOOF and AMP, still in the dividend trap model for you guys?
Well, they're still struggling. AMP, another update this morning, AMP came out with its first quarter numbers, and outflows were still continuing very strongly. Their retail outflows were about 1.8 billion, which was higher than the market expected. So it's still tough times there. They announced a new CFO as well, so they're clearly trying to do the best they can, but in our models it is still pretty much at the bottom of the financials.
Right. Any comment on IOOF?
Look, it doesn't look quite as bad as our models, but it also has other issues with the regulators and what have you. So I probably prefer not to comment, but they're not the best sectors. We prefer to like the likes of Macquarie and even more recently QBE are stocks that we prefer in those sorts of sectors.
Excellent. Don, in terms of resources, is it as good as it can get for iron ore miners, and can resources in general maintain such high payout ratios?
Well, it could always get better if commodity prices go higher, but it is a very good period, and it's hard to see it getting a lot better because one of the benefits and reasons why iron ore prices have held up well, in fact further gone up this year, has been some problems in Brazil. Vale's had now 2 dam disasters. The first one was also a joint venture with BHP, but the second one earlier this year was a wholly owned subsidiary of Vale, so they have had to close that mine and a few others, and that means that supply has been quite restricted and prices have gone up. I think the good news is that yes, they can maintain their current payouts because Unlike previous cycles where the immediate reaction by the industry is to go out and build another mine, is that they've been quite restrained at not significantly investing in new mines and then increasing supply and then deflating prices. So they've had much better supply discipline, which also means capital discipline, so they're able to return that capital. Having said that, BHP's special and its buyback and Rio's buyback were basically because they sold assets, and they can't continue to keep doing that, but they can, I think, maintain the current dividends if commodity prices stay where they are.
Mm-hmm. Don, in terms of Australian stocks, how have they performed in terms of dividend run-up this year? You mentioned dividend run-up in your slides.
Yeah, look, it's been a mixed result, but generally speaking, not too bad. So, I mean, there is a lot of noise around that run-up. It does vary year to year, but we haven't seen any significant changes in the pattern, so we're still comfortable with it.
Okay, another question that's come in. With all the buybacks, do Australian companies have any franking balances left?
Yes, they do. I mean, even BHP and Rio have more franking credits. I mean, they've just distributed a huge amount, but they still have more up their sleeve. The problem with them, or the question, is how they can get them out. But there's also a number of companies who haven't been able to flush out their franking. So the likes of Harvey Norman has a very large franking account balance, but it just doesn't have cash, and it hasn't sold something, and so it's difficult for it to pay it out. So, look, there are in some pockets, but on the other hand, some of the big dividend payers like the banks, apart from probably Westpac, they're all they're not sitting on a huge amount. So there's still some around, but the problem is those companies often don't have the cash to pay the dividends.
Okay, now we did have another question come in which wasn't investment related, just in relation to the Plato Australian Shares Income Managed Risk Fund closing. Just advising clients, that is a small fund that Plato have run over the last couple of years, not to be confused with the main Plato Australian Shares Income Fund. That fund is closing in the next couple of weeks. There is no plans to close the main fund. The main fund is $1 billion fund, and we have an external party that was also involved in the Managed Risk Fund, and there's been a decision to close that fund, which is a very small fund, around about $10 million. So just wanted to cover that off for any people who have any questions on that Managed Risk Fund closing. Yeah,
just on that, and maybe this was where the question was coming from. So some people have asked, given the change, if the ALP get in and if they can get their franking proposal up, which I think still should be considered as is, would that mean that we would change the way we manage the current fund, the Plato Australian Shares Income Fund? And our answer to that is no, because we've analysed the clients, we've looked at them, and the vast majority, we believe, are still able to use the franking. We have quite a few charities in there, and the bulk of our investments are actually on platforms, APRA-regulated funds, where the clients can still use the franking. So the actual proportion of direct investors who are in the self-managed super funds or individuals who might, and we don't know their tax status, but might be affected by the ALP proposal if it comes in, is actually quite small. It's less than 10% of the fund. So we wouldn't be changing the way we run the fund. What we have said is that if the changes come in and if there is enough demand by investors who can't use franking, we may consider launching a new fund for those investors where we're trying to maximise the yield with no focus on franking at all, because those clients use franking.
Don, that probably means things like the 45-day rule obviously don't apply, and you can be more active in rotating through dividends, delivering high
That's correct, but also means that because those clients don't value franking, you wouldn't actually participate in the BHP, Rio or Woolworths buybacks, because you have to use the franking to do it. So that's something we'll think about, but we need to wait and see about the election, but also about whether the makeup of the Senate and whether the ALP can get their proposals through the Senate.
Fantastic. Well, we might wrap things up there. We will be making the webinar available on the Plato Investment website later today. It's www.plato.com.au. We'd certainly like to thank everyone for their participation. If you have any further inquiries, please do not hesitate to contact one of the Pinnacle distribution team or contact the Plato website. Thank you for your time today. We look forward to speaking with you at our next webinar or in person at one of our luncheons or office meetings. Thank you very much and have a great day.